And so you can actually move it into a custodian that is able to, allows you to invest in alternative asset classes. And so one of the options that I chose was private money lending. And so it's essentially just lending out as
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. Many fortunes have been built using retirement accounts as a way to defer taxes. The key is applying careful research and proper structuring to use these retirement accounts for commercial real estate. Well, today's guest knows all about this aspect, as he has direct experience in retirement accounts beginning at the age of 16 when he opened his first Roth IRA and began trading in equities. Now today, he is a multifamily syndicator who specializes in helping investors use their retirement funds to passively invest in deals. Now through his company, Wall to Main, he helps his investors seek out stable returns through workforce housing using self-directed IRAs, among many other methods. Now, with all that, I'd like to welcome Josh Plave to the show. Hey, Josh, thanks for coming on.
Thanks so much for having me. I appreciate it.
Yeah. Now, if you like what Josh has to say, you can reach him via his contact page at wall2main.com. If you like our content, please don't forget to leave a comment, rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Josh, go ahead and tell us a little bit more about how you got your start in this whole thing.
Yeah. So thanks for having me, Agostino. As you mentioned, I'm a young guy. I'm 30 years old. I got started with retirement accounts when I was 16. My mother and my grandfather were both CPAs, and they suggested that I start planning for my future. Not a lot of teenagers are really looking out for themselves down the line. And so I thought I'd do that. So I took the money I'd earned kind of that summer and I started investing in stocks and bonds at a young age. I've been trading ever since. I continued to, add to my account, build it and grow it to the point where now I've been able to use it. But fast forwarding about 10 years from then, when I was in my mid 20s, my mother and my grandfather, unfortunately, both passed away. And what that did was it actually left me with the retirement accounts of a baby boomer and a member of the greatest generation. It wasn't a life-changing amount of money, but it was enough that I needed to make sure I was going to be a good steward of, everything they've worked for, preserve their legacy, and make sure that I was taking what they had earned and really, propel it into the next generation. Make sure I was not just going to blow it all up on the first thing that came along, and really dig into what was going to be the most powerful and impactful thing for myself, as well as my sisters who were in the same position. And so I got to work. I just educated as much as I possibly could. I watched webinars, podcasts. I went to seminars. I did everything I possibly could, and tried to, because I had no real estate background, I was trying to gain some sort of a real estate understanding of where I wanted to head. And I knew I wanted to jump into whatever I eventually was going to do first. I didn't want to kind of flounder in flipping or wholesaling and then move forward. So I eventually landed on multifamily, which I realized I wanted to scale quickly. And so I jumped in there. And at the same time, because I knew it was going to take some time to kind of build up a multifamily operation, I actually began private money lending as well. So that's what I do currently. We private money lend and we do multifamily.
Before we get into the whole retirement savings account thing, the fact that you got into this at a very young age is one of those things I'm sure that for many parents listening right now, myself included, it's one of those things that you want to get your kids involved in, like very, very young. As someone on the receiving end of some of this information that you're hearing from your mother and from your grandfather, how did you first hear it? And if you recall, how did they say it in a way that actually got you to take action towards what they were saying? Because I would say that for most kids, they're not that interested in real estate. At least I reflect back on when I was a young kid. I was all about computers and technology. That's what my background is. But do you recall, or would you have any advice on what people should be telling their kids to get them really enticed to become investors?
Yeah, they knew who I was. You mentioned you were into science and technology, and I was fairly similar. I was kind of on more analytical side of things, and so they knew who I was, and so they came at it from that numbers and statistics background, where the first and most impactful thing I remember being shown was a compounding interest calculator. So when we plugged in, hey, if you just put in $1,000 a year and then you start upping it every few years to a few more thousand, and you get a steady 6-7% return in the stock market, here's what it'll look like. And I was like, oh, I can have $1 million or more when I'm like 60 years old. Amazing. So that was the first thing that really opened my eyes. And then from there, they kind of just they would quietly, and I realized it was more inception at the time, but they would start to show me kind of how to evaluate stocks, how to take a look and properly evaluate an opportunity and make sure that I was getting involved in something I understood. And that's why the first investment I ended up doing was actually what I was really passionate about at the time, was aviation. I was obsessed with planes, so I just invested in a mutual fund that was aerospace minded, because I knew the market, I knew where it was headed, and it did very well actually from that point forward. So I kind of learned to invest in what educate yourself fully, and yeah, just that watching your account balance grow over time was the thing that really sprung to my mind. But they knew who I was, and I don't think that would necessarily be super impactful for every single kid. So you just gotta kind of mold the message to whoever your child is.
Yeah. No, and I think that part's huge, though, right? Is that I think you're exactly right. You got to mold the message to the child that's listening, and try to get them to internalize it in a way that they understand it. Like the way you just said too, the analogy, not even the analogy, the thing about how you're really into aviation. So great, invest in aviation stocks. You'll be keeping an eye on it. You're gonna, and since you're into it, it's gonna be exciting for you, right? And like back then, I remember I was into, like I said, technology. So uh, I remember as a young guy when I used to do stocks and all that stuff, it was all about Microsoft and Oracle and all these different things, and I would track them very, very closely. I don't do any of that stuff anymore. I'm 100% into real estate, so I don't even have any stocks. I don't even keep any. Everything's all in real estate because I want control over what I want. But I guess the point is that uh, to your point, you have to tailor your message to the audience. In your case, as a young kid, and really get them to internalize it. And I think that part is absolutely huge, absolutely huge. So, but fortunately, they hit the nail on the head, and you got into this Roth IRA. So what was the logic around the Roth IRA versus something else?
Yeah, I mean, at the time, it was as simple as, do you think you're going to make more than $2,000 that you made this summer when you're 50 or 60 years old? And it was yes. I mean, a Roth IRA is essentially you betting on yourself that you're going to be in a higher income tax bracket when you retire. And so you're paying the taxes now. Currently, we're at historically low tax rates, like literally the lowest we've ever had to pay for income tax. And so the question is, when you end up, if you start pulling the money when you're 65 or 59 and a half, when you're that age, do you think you're going to be making more than you make right now? Well, when I was 16, I definitely thought I would. So I felt that I just pay the taxes at one time. I remember I put in $1,000. I ended up having to pay 300 bucks on the was it 300 bucks, 250 something on the taxes. It was like super minimal, and then that's all I'll ever have to pay on them forever. And so they're now sitting in a private money loan in Boston on a flip property. Someone else is working the property for me, and they're earning at a higher rate than I ever had to pay taxes on back then. And so, yeah, just I mean, as a young person, I continue to add to Roth. It makes more sense in my mind at a younger age. I'll probably taper that off over time, but it's super powerful. Just the ability to grow that account as much as I possibly can, and then the ultimate goal is to grow it as large as I can, so I can start taking a little bit from it, but really pass it on to my children or my ancestors. So the stepped up basis is going to end up being purely tax free for them as well.
Hey, Augustino here, and I would love to connect directly with you. Text the word books to 202-410-4202 to receive weekly book recommendations from me. So let's continue that example then. So you set up this Roth IRA, you've been setting money aside. Now you've basically taken it out, so to speak. I'm not even going to say take it out. I'll let you explain that. But you've lent it out to somebody and you're going to get capital gains on that. So how does that work then in terms of your scenario? So it's gonna go into this flip. I'm assuming that this person who's got this flip is going to give you obviously a return, or they're going to get interest. What are the tax implications? What are the benefits? Why would you set it up this way?
Yeah. So, this is what's called a self-directed IRA. IRAs, 401ks, they're not limited to just stocks and bonds. That's really just what the custodian that most of our money is sitting at. That's what their operations are aligned for. And so you can actually move it into a custodian that is able to, allows you to invest in alternative asset classes. And so one of the options that I chose was private money lending. And so it's essentially just lending out as a note, and because it's interest income, it actually continues, it maintains its purely tax-free environment in an IRA. And so I just collect interest income. I'm collecting at, I think 15% currently because we're past the maturity date on the note, and it's just the way you structure it. But interest income is totally tax-free. On the flip side, if you use your IRA to invest in a multifamily deal, there are tax implications. And so, I built a UBIT calculator that can actually take advantage, or can, help understand, an investor understand really the full implication of what they're getting involved in. But there are other ones that don't. There's the solo 401k, and that one, if you can sponsor it, that has no tax implications. So there are really some benefits, some drawbacks to some accounts. There are certain ones that some people are eligible for that others aren't. So it's really important to kind of educate and get as much information as possible and understand what applies to you. But there's a lot of different directions that you can take your retirement for sure.
Excellent. Now, can you explain the UBIT as well for those people that aren't familiar with it?
Yeah. So if you're familiar with, multifamily or any kind of leveraged investment, what happens with an IRA is, if you invest in a syndication, and let's say that we're buying a property with 25% equity, like the down payment is going to be 25%. The income that is generated by that 25% is never taxed. It was your money earning, tax-free income. The 75% that's coming in from an outside source, a lender or a bank, that's coming in from, not a retirement account. It's not tax deferred. And so any income that's derived by, let's say, that 75% is going to actually incur what's called, or it's going to generate what's called UDFI, unrelated debt financed income, because that unrelated debt is generating some income. And so you end up paying a tax called UBIT, unrelated business income tax. And the thing is, you have to pay a decent tax on the 75%. But the nice thing is, because that outside debt is not tax, or is not retirement money, you can actually use that portion of depreciation or expenses or any kind of other losses to help offset the UBIT you have to end up paying. So in the first year, if you have to pay taxes on 75%, you get to use 75% of any kind of expense or loss to help really offset those things. And so when I built the UBIT calculator, it really helped to understand how impactful that's going to be. We found that for the first 3 to 4 years or so, cash flow is really, any returns from that, there's no taxes. If anything, it's either $0 to like a couple thousand, or like $1,000 on a $10,000 $100,000 investment. Sorry, but it's pretty minimal, but the ultimate larger tax is on the capital gain, and so you need to understand the full picture of what the implication will be on how much you need to pay on a capital gain tax.
Excellent. And the calculator is on the website, right?
Yes.
Like waltermain.com. So yeah, definitely you guys ought to check it out and see how taxes will affect you and what you're investing in a deal. That's very, very important. Very important. So right now, I mean, as we said earlier, you're a syndicator and you're helping people get into these deals. And I know that you're really big on using retirement accounts to do this. Now, obviously, we touched on some of the tax implications as to why. What sort of other reasons should people be listening to, your investors be listening to you when you first approach them to invest with their retirement savings?
Yeah, there's a couple reasons. The main ones surround consistent growth and stability. So, a lot of it grew from a conversation I had with my dad, because we're trying to build his retirement plan for the next 5 to 10 years as he starts to kind of reduce hours and move into retirement. And he earns at a high level right now, but we know he's going to, tap into his 401k when he ends up retiring. And so we were taking a look at it and we were wondering kind of cyclically, where's the market going to be? Because he's all in equities right now. Where is it going to be when he has to pull from his 401k? And there was kind of that unsure moment where we were saying, is the market going to be there for me? Is it going to kind of fall out from underneath me? Will my account balance that I've been growing for years be there in its entirety at that moment? And so ultimately we decided not necessarily. I took a look at kind of how things have played out since 1990. So over the last 30 years, multifamily has actually been 58% less volatile than the S&P 500. It just doesn't have those large up and down swings. It just consistently grows at a 9 to 10% clip. And you're never going to really have an account balance that just completely craters when you need to tap into it the most. And then on top of that, you've got the ability to leverage your retirement account. You have the ability to have those larger size returns, but also, apply them to your retirement account. We know we can all do it with cash, but when I learned that you can actually apply leverage to your retirement account, that was huge for me. That was the game changer. That was the big light bulb moment for me. But it really helps me sleep at night knowing that my account balance is always going to be there, but I'm also not sacrificing it at the expense of, getting into something that's really stable, but very slow growing. It still has the ability to, you're buying into a business. It's something that someone is going to force appreciation on. They're running the operation. And if you find an operator who you can trust, you have a greater control over your future.
Got it. So for someone listening right now, maybe they're, they've heard of all this, but they're not entirely sure how to do it, what to do. Maybe they're even a little bit scared because, if something is new to them, they get a little bit freaked out, right? What sort of things would you recommend then? Like, as far as maybe like how to start? Like, obviously you talk to them, you get them comfortable with the idea of retirement with their savings, or rather investing with their savings, retirement savings. So do you usually broker the conversation between them and, like, say, the custodian, or do you walk them through something else first before you do that? Like, maybe tell the audience a little bit more about how would you not only sell this to an investor, but also help them get through all the way to the end? Or do you even do that?
Yeah, it's funny you asked this because when I was building my business, I kind of had to decide, the type of person I was going to try to help, the type of person I was going to bring on as an investor, and I realized there's really two avenues here, and a lot of people that listen to podcasts or are already kind of in the real estate world, they have a general understanding of real estate. They have an understanding of passive investing or syndications. And so I didn't necessarily need to walk them through here's what a syndication is, but I needed to give them the retirement account, how that plays a role in investing in a syndication. And so I built a video series for that. And then I also built a video series for, walking people through what is passive investing, the people who really have no background in both real estate or the retirement side of things. And so it's kind of two perspectives. It's either you got to start from kind of ground zero and you show them what multifamily is, how it operates, how you derive value, and how you end up forcing that value upwards. And then also why retirement accounts, align very nicely with that asset class as well.
Interesting. Okay, so good. So you do that part. Now, do you have a preferred custodian that you typically work with then, or how does that part work?
It's funny you followed up with that because that also I have like a kind of two pronged approach to that. Um, I kind of apply it to two different types of investors. If it's the ones that are going to be, because with a retirement account, you can only passively invest. You can't actively control any account, any investment. If you plan to just passively invest in kind of one thing, if it's a multifamily syndication and that's you're going to be your bread and butter, that you don't have a lot of questions and it's just the same thing. You get your returns, you apply them to an investment, you just keep chugging along and rolling the ball down the field. You're I have a company called Rocket Dollar that I use. They're very powerful. There's a couple of different companies just like them. I personally opt for checkbook control. It gives you the most power, keeps the overhead fees the lowest, and allows you to have the greatest ability to quickly and nimbly use your account. They are really great because they set up your account for a really low fee. the reoccurring fees are super low, and then there's no one there to hold your hand, and you can just go and deal on your own. If you plan to kind of get involved in other things, like if you want to get involved in rental properties like single family homes or maybe possibly flipping, but you also want to do some multifamily, if you kind of plan to expand your empire further than just the one thing, then I also use a company called Safeguard Advisors. That's who I originally opened up all of my accounts with. Uh, the nice thing with them is it's a little more expensive. It's not super expensive, but they actually are there constantly for you to ask them questions. They're a consulting service that will be there for you to say, hey, is this a prohibited transaction? Is this something that's allowable that I can do? And so you can always pick their brain, which is really nice to kind of have that backstop to know where you should take your retirement account next.
Right. Well, and it's funny. I didn't hear you mention equity trust, so it sounds like you're obviously aware of those guys, but they're not exactly the cheapest ones out there either. So not that this is a show about bashing custodians or anything else like that, but I think that equity trust is probably one of the more recognizable names out there. But there are others that maybe you should look at as well. As like I think you said pocketbook control. Is that one of them? You said
Well, it's a checkbook control, but Rock Dollar is the company. Yeah.
checkbook control. Yeah, yeah, yeah. So, and it sounds to me like if you don't plan on really interacting too much with that custodian, that sounds to me like it'd probably be the least expensive option. I imagine. Good. Well, it's good. Definitely one to look out for then. So super. So, it's funny because we're syndicating deals as well, and oftentimes these sorts of events will come up where we're talking to somebody and they don't really know where to go to set this stuff up. So oftentimes we're having these same discussions, and I often try to broker the conversation between that potential investor and a equity trust or an I plan or one of these other guys, to really help them get into the deal, right? Do you also, like, after all that happens, do you like take them all the way to the end, or do you try to like play a hands off approach type scenario?
Yeah, I mean, so it really, I guess I do it on an individual basis. I try to provide as much education so as possible so that my investors kind of know where to go. And the nice thing is the partners that I've chosen, they're the kinds that also they hold their hands, from beginning to finish of establishing the account. So there isn't really a ton that needs to go down there. But the reason that I do go for checkbook controls as a syndicator, we've actually seen folks who have a self-directed IRA without checkbook control, that they need to apply for paperwork and application, and they need to make sure that it's getting approved by the custodian. And as a syndicator, we've actually seen people almost miss out on an opportunity by the fund's due date because it's just taken 3-4 weeks just to get the paperwork cleared. It doesn't always take that long, but there are times when certain custodians are swamped or they just aren't responsive, and it just takes a while. And so that's frustrating. I never want to see an investor miss out on an opportunity. They've vetted themselves. They know they want to get involved in, but somebody else is getting in the way of their future. And so that's why I always advocate for checkbook control, because it allows for my investors to, I like to joke, like find a deal at breakfast and fund it by lunch. I mean, if you are able to vet a deal that quickly, great. But it's that simple. You just wire the money over, and there's no more worry beyond that.
Right, right, right. Now, keep in mind, guys, for those of you listening, we're not CPAs, we're not attorneys or anything else like that. Get your own legal advice, your own advice when you're doing this kind of stuff, because I think that safeguard that you're talking about, as far as whether it's going to break the law or not, or there, that is a safeguard, even though it takes extra time. And I know that sometimes it's those times that is very frustrating. I understand, but with checkbook control, there's a risk that you could blow up your whole 401k or your whole self-directed IRA rather, if you just throw your money at something that's not, that's on the line or in the gray area or just totally not allowed, right?
Yeah. And that's why I say, like, if you know what you're getting, if you're going to continue to do the same thing over and over, go for a simple checkbook account, because there's really no questions you need to ask. You're not going to get involved in anything that's going to blow it up, most likely. But if you are doing things that, it's the first time you're doing it with your retirement account and you want to check, do it with someone who, is going to be able to walk you through that. And there are things you need to look out for. There are rules and regulations behind what you can and can't do before you get started that you need to know, before you have a checkbook account. But just like anything, you need to be fully educated on it really before you start getting investing.
Excellent, excellent. So, in terms of your general clientele, then, what sort of people are actually taking advantage of the retirement savings aspect, that angle of when it comes to investing in your deals? Are you finding it's typically the corporate people? It's the people that are maybe closer to retirement, or who are these folks?
Yeah, I would say it's more the corporate folks who they've really the most impactful way to do it is if you've built up a large 401k at a previous employer. So if your 401k is locked up at your current employer, you're probably not going to be able to move the money outside of that account, out of that plan. So if it's with a past employer, you now have a large balance that you can use and move into whatever you want to do. And so I'm finding, yeah, it's mostly folks between 30, 45 who are further along in their career, maybe reaching the tail end of their career, and they've got that balance, and they know they either want to keep it stable, or they know, hey, I have kids now, I got to start thinking about greater costs at the time of retirement, or I might need to be able to dip into this account. With Roth money, you can always pull out your contributions, for example, tax free. So they might know that they want to take out those contributions, but they want to grow the earnings beyond that. And so it's kind of that timeline where you're thinking, okay, I need to have a new plan. I need to start shifting gears into something a little bigger. And so I'm finding that. But with older people, there are actually different strategies you can apply to it. You can look for things that are more cash flowing because you can take distributions out if you're over 59 and a half. And so with older investors, I tend to look for opportunities where it's cash flowing from day one, and they're going to receive distributions, and they can take those distributions and then distribute it out to themselves as just general income and pay off their life expenses. So there are different strategies that you should look into as a retirement investor, but they're all valid.
Yeah, and that probably leads me into my next question then. And so, as far as the stuff that you guys are investing in right now, syndicating, I'm guessing that you're investing in like both those cash flowing and those appreciation type of assets, and those are two very different investors, right? So let's talk a little bit about that then. So where are you investing these days? Are you staying close to home, and or are you going outside of your state, and how are you doing all that these days?
Yeah, well, I actually just moved to Charlotte, North Carolina, so I would love to invest in my home. But yeah, I we primarily invest in the Southeast. The majority, as I mentioned, the majority of my investors are folks who, they don't have access to their account for a while, and so they don't mind the longer hold period. They don't mind something that's a little deeper value add, and so we're looking for assets that we can reposition. We're looking for things that are built, maybe in the 60s, but likely the 70s and 80s. We can reposition them from a C into a C plus, a B minus into a B, 90 to 250 units, but all across the Southeast. I did my first deal in Texas. I've invested myself in Memphis as well. And so we kind of look all across that area because that's really the area where you're able to find those distressed properties. Things that were built in the 70s and 80s haven't really been looked after well. You can go in and you can bring all of your investors into the property and really start to force appreciation and make sure you're turning it into something that the tenants are proud of to live at.
Right. So it sounds to me like you're doing the value add type scenario. You're trying to find those assets and really position yourself as someone that's going to go in there, do the value add, keep it for it's going to be a 10-year hold, maybe reposition, and within 3 to 5 years, refi it out, give a return, and then cash flow to the cows come home, I imagine, right?
Yeah, that's pretty much the target. We do a few that are more hybrid that are cash flowing from day one, but they also need some, like when somebody leaves, you go in and you start to slowly, improve the value to it. But yeah, it's primarily those deeper value add ones.
Yeah, yeah, yeah. I mean, yeah, it's man. I'll tell you, as a syndicator myself, yeah, those deals are they're hard to come by these days. Very tough to come by, but I mean, they're out there. It just takes a whole lot more work to find them. That's the thing, right? Right. So now, so who's the boots on the ground then in the southeast there? Then like, so obviously you're not there, right? You're back at home. I'm assuming you're trying to source. You're sourcing deals remotely. You're creating those relationships, I'm guessing. So who's the boots on the ground out there?
Yeah, so I'm part of like a larger kind of mastermind group, and so we've got people all throughout the Southeast, which is really nice. We have people who are in Atlanta, who are in the Texas market. I'm now in Charlotte, and I can look at the deals that we're looking at, all across North Carolina. So, but when it comes to investing out of state, you need to be readily available to fly and to be willing to go to where you can meet people face to face. It's a little hard during COVID at times, but it's what's really going to set you apart in finding opportunities is meeting people, shaking their hand, and saying, "Hey, I'm real. I'm a serious buyer. I'll be able to close on your property." Because if you're just another name in the Rolodex, then it's a little harder to get on the short list. It's a little harder to understand the market. You need to be there to actually drive around, take pictures of the property, spend a week there just rolling into every potential apartment complex, taking photos, understanding what's in the market. So when something does come up, you either have pictures or an idea of what that part of town is like, or you have the comps nearby, and you can say, "Hey, this is what places have gone for. Here's what they've been repositioned into," and you have a better understanding. So, it's you're not always going to have necessarily somebody right there, but if you don't, you got to be willing to go there.
Yeah, yeah. And I think what's important to bring everything all the way back to the whole point of this show today is that as syndicators, we're putting these deals together, but we also need to match up those investors with the asset and get them to invest. And one thing that's often overlooked is the use of retirement money. Those retirement funds can be huge for, of course, the project, but also for that individual investor. I'm sure many of them are fairly astute. They know what can be done. But for those that aren't, it's I think as syndicators and investors, if we're able to help them cross that chasm and get them comfortable with it, it could be huge, huge for that partner, huge for them. I mean, in terms of the tax savings, is enormous. Yeah. So Josh, so someone's listening right now, and maybe they're thinking about offering such things to their investor pool, or maybe they're they're just thinking about this whole episode. Now, what sort of bulletproof advice would you offer to that person?
It's kind of like a two-level approach. The best advice I really ever got that applied to real estate or entrepreneurship is focusing on one thing, like the one thing. And so when I started my business, I made sure I was focusing on the one topic. I was focusing on building the educational content. I was focusing on creating videos or whatever it was at that time. And so you dive in as much as you possibly can education wise on one specific topic. You go from 0 all the way to 100, and then once you're there and you feel like you kind of mastered that little bit, you move to the next thing, because you're not going to lose that education that you just had. Now you can move to a second topic, dive into it fully, give it your full attention. And I found that I'm actually able to grow myself, my business, in a more effective way by focusing my attention, as opposed to kind of trying to be a jack of all trades at once.
Yeah, love it. Focus is huge. I'm a big proponent of that. It's probably one of the things that many people try to take on too many things at once, and none of it gets done. So the power of focus is something that I totally agree with. All right, guys. Well, if you want to reach out to Josh, you can reach him via his website at walltomain.com. I hope you got some insight on how you can bypass your tax hit and minimize your tax burden through the use of retirement savings accounts. Thanks for tuning in. I'll see you in the next one. Take care.